Welcome to my personal finance channel. This is the channel which will give you advice on personal finance. However, we touch on a variety of subjects that might directly or indirectly contribute to your personal financial well-being, like the state of the entire economy. Although on a day-to-day basis you might not see the impact, overall it does impact your finances. So we are going to dive deep into the Canadian economy and how it is forecast to be starting from 2024 going into 2025. The Canadian economy outlook as in 2024, it outperformed expectation, avoiding a recession that some had predicted. We had inflation which had been induced as a result of supply chain constraints from the pandemic, which saw inflation rose to about 9% here in Canada, but somewhere in Europe was around 12%, 13%. But we are not yet out of the woods. We still have a long way to go. On an average month-to-month basis, it fell to 1.6. But it's currently, as we speak in November, sitting at about 2.2%. But this is average on a month-to-month basis. The economy beginning to settle down, with the Bank of Canada easing its policy and paving way for stronger economic growth ahead. So economic grew and also household confidence grew. Inflation went down, averaging 1.6, but around 2%, 2.2 as of the second of the year, up into this third quarter. But in October, the inflation is said to be somewhere around 2.2, 2.3, depending with what data you factor into it. GDP growth is up at 1.5 in 2024. It's expected to grow to 2.5 in the second half of 2025 due to exports, energy, and the motor vehicle exports. Population growth to go down due to the government cut numbers in immigration, so that might impact the growth of the population, because the Canadian population is growing largely immigration and it's slow organically. So the GDP per person is expected to grow up to 2.5% in the second half of 2025. Consumption in 2025 will increase from 1% in 2025 to about 2.25% in the second half of 2025. So consumption per person is going up as interest goes in the other direction, because given that inflation has stabilized, right now we are sitting at 2.2. The Bank of Canada is going to convene a meeting on the 11th of December, of which they might cut the interest by 25 basis points. That is the general consensus by leading economists. We don't know their decision yet, but I think given that in October the inflation rose on a month-to-month basis, they might not go beyond 25 basis points. But we are within the target of 2%. However, this outlook is subject to considerable unpredictable differences in households. So certain households see lower debt repayment due to lower interest. Some might experience a large increase in debt repayment, longer term mortgage rates. Interest is going to go down. It does not necessarily translate that the mortgage might immediately go down drastically. So In certain mortgage repayment, the interest will hold, but they will not see an increase. Some variable rate mortgage holders will deal with a higher principal payment once they reset their amortization schedule. The diversity of exposure makes foreseeable strength of the aggregate a difficulty. Growth in residential investment is projected to go up to 8% in 2025, and it might temper around 4% in 2026. Population growth due to newcomers is projected to decrease since government has decreased the number of immigrants it is taking per capita. Interest is projected to go down in the second half of 2025 as government will continue aggressively cut the interest rate as inflation begins to stabilize. They expected to cut the interest rate by 25 basis points, but as inflation fell, they might cut the interest rate by more basis points. This makes money cheap to borrow, which will then spur some growth into the economy. The rent rose, certain people vacated certain properties, and the vacancy rate rose in certain commercial properties. So as interest goes the other way, it might put pressure on the prices. It will put pressure on the prices to go down. The price of these commercial properties will go down with interest. And as the prices fell, the vacancy rate might fall as well as people move back into these commercial properties. Business investment is projected to go up by 4% in the second quarter of 2025. So as interest rate fell, money becomes cheap, and business will borrow more, and business will expand more, and the economy will grow. Interest falls, money becomes cheap, businesses borrow more, and this will spur growth in the economy. Investment is projected to go up in the second quarter of 2025 due to easier financial conditions. Money is becoming cheap, and businesses will borrow more and invest more, and the economy will grow. Export growth is projected to rise in the second quarter of 2025 to 6.5%, and then will moderate to about 2% in the third quarter. Motor vehicles should rebound. Growth will also moderate to 2% by the end of 2020. So export growth is projected to be around 6.5% in 2025, which will moderate to 2% increase in 2025 once down. And also motor vehicles should rebound. Growth in that year will moderate to 2% by the end of 25. Inflation is anticipated to be sustainably at 2% by the second half of 2020. Housing market imbalances and labor cost growth are expected to remain on an ongoing source of up on inflation. The housing market here in Canada, housing demand exceeds supply by far. As a result, this has put pressure on the prices of houses. One of my trips to North Carolina, I saw a house which was being sold in one of the neighborhoods here. It looks identical. I'll put the amount in United States dollars. The asking price here in Canada was about $850,000 US dollars. But in the United States, in North Carolina, the same house In an upscale neighborhood, the asking price was 400 United States dollars. That means here in Canada, houses cost almost double. We need government initiative to build more houses so that houses can be affordable. Last aspect of this one, housing market, the imbalances, the supply and demand in the housing market will put pressure on inflation. That is a very large component of our inflationary pressures. If the prices of houses temper down a little bit, it will alleviate the pressures on inflation so that we reach that core of this sustainable 2%, which the banks always shoot for. There is a government initiative to build more houses to increase the supply. Also, in the rental market, the government needs to take initiative to encourage builders to build more rental property. So it's like you increase the supply, that's simple laws of supply and demand in economics. You increase the supply, and that will put pressure on the prices to go in the other direction, in the south direction. The supply increase, demand remaining the same, the prices will fall, and this will also alleviate the inflationary pressures. So, ladies and gentlemen, in 2025, to sum up everything, just in closing, the Canadian economy is expected to grow in 2025. The interest easing up, money becomes cheap, businesses borrow more and invest more, and as they invest more, they will spur the economic growth and also create more jobs. On the contrary, we might have this wage push inflation factoring in as people are demanding more wages, which has been pushed by inflationary pressures in the market. As people demand more wages, the manufacturers of those goods have to factor in the wage rise into their production processes, which might also result in some inflationary pressures. So thank you for watching my videos. Time to time we bring you great news, and please subscribe to this channel.